Did you know that 90% of the world's millionaires invest in real estate? Well, I'm Angel with the Academy Presents Real Estate Investing Rocks, and I'm here to help you if you want to go for your piece of that pie.
There's a question too. Somebody asked, what is the best way to get a home to sell with little cash?
What do you mean?
How to acquire your first home to sell.
How to acquire your first home to sell?
So I guess she's saying, so you don't have a whole bunch of cash, so how would you acquire the first home to do the owner finance with?
I'll go through some ways in just a little bit. Why don't you hold off on that question for a little bit? Hold off on that question till the end and see if I cover that one. And then you're gonna hire professionals. Always hire professionals because they will keep you out of trouble. Okay? The professionals you're gonna need. First one is an RMLO. In Texas, I always say Texas Pride. They're super easy. And by the way, send me an email if you want introductions to any of these people. But you can always Google them. RMLO, which is a residential mortgage loan originator. Okay? RMLO. These are the people. You're going to send your contract to them. Okay? And then they're going to contact your borrower and they're going to underwrite your borrower, which means they're going to collect all of the documents from them. They're going to collect like the tax returns. They're going to collect the bank statements. They're going to make them fill out the application. They're going to collect all of that and do all of that for them. They are going to charge your borrower money for that. You don't pay for that. The borrower pays for that. Then you're going to have an attorney. The borrower pays the attorney. You don't pay them. Okay? Then there's a title company. If you're smart enough, you're going to have title insurance, right? Because if down the road you decide to sell your note, you have to have title insurance on this note in order to sell it. Now, at that time, if you didn't have your borrower pay for title insurance at the time of closing right now, you have to pay for it. So get a title company and have title policy done now and have the borrower pay for it. And then have a note servicer. And guess what? If you set it up now at the time of closing, your borrower pays for it. You know, so all of this your borrower pays for. There is absolutely zero reason to go, oh, well, I want to save my borrower money. No, your borrower cannot go get qualified for a loan. You want to, one, protect your borrower. This is all for their benefit. And you want to protect yourself legally. Do you want to be sued? Here's what happens if you don't use an RMLO. If your borrower all of a sudden decides to stop paying you and you go and foreclose on them and decided to save them money in this thing, decide to save them their $1,000, $1,500 or whatever it is, and they go in front of a judge, the judge can decide that you're a bad person and completely unwind the transaction and make you pay back every dollar of interest and all of their down payment. Send them to the RMLO and make them pay the RMLO for all of that work done. Believe me, it's not that expensive, and the borrower should pay them. If they don't have money to do this, they should not be buying a house. This is the way it is. And sorry, times are tough. I get it. Times are tough, and everybody wants to own a home. But, you know, not everybody gets to own a home, and maybe they need to wait a year. And, you know, don't be so desperate. You know, make sure that you wait for the right borrower and the right buyer. Okay, so avoiding legal trouble. Number one, use professionals. I know I'm beating a dead horse here, but the amount of people who avoid this step is staggering. Use professionals, make your borrower pay for it. Buyer pays fees. Again, the amount of people who are like, oh, I'm going to pay for this. Don't. Why? The buyer pays for all of it. Transfer of ownership. This is important. There is no reason not to transfer it. There is no contract for deed in Texas. I don't know why people think that if you don't record a warranty deed in Texas, that for some reason you just can go foreclose on them if they decide to stop paying you. You can't. If you don't record a warranty deed in Texas, it's still a legal sale. It is. You don't have to actually record a warranty deed to make it a legal mortgage. It's just no contract for deed. So I'm not really sure how that all works. but you have got to record your deeds. And it really, if you decide that you want to sell your note, believe me, it raises red flags with note buyers if you don't record all of your deeds in a timely fashion. So make sure and record all of your warranty deeds and deeds of trust. And it's weird, and I see it all the time, and I know why. It just makes you look a little shady if you don't record your warranty deeds and deeds of trust. And we've already talked about the due on sale clause and land trust. So, and just remember that due on sale clause, we're going into a time right now, banks are not going to call this. And I know this from personal experience. All right, sources of underlying financing. So our friend, I'm sorry, ma'am, I forgot your name. What was her name?
Wanda.
Wanda. These are sources of underlying financing, and you don't have any money. And, this is a big thing. How do you get your first property? So I got to be honest, when you're getting starting in real estate investing, you need one of two things: money, you need experience. You got to have one or the other. So if you don't have either of those, you're going to have to get a partner. So start looking for a partner. There are a lot of people out there who have money, but they don't have any time. A lot of them. And I'm not kidding you. They got so much time or so much money, but they really don't have time. And we're not talking about, you're not looking for a lot of money. You're really not. What are you looking to give up? What percentage are you looking to give up? You really need the experience. You need a learning experience. You could probably give up a lot of profit. You want an education for a little bit. Do you want cash flow? Do you want, again, I don't know what your goal is, but you need to make it probably worth somebody's while and go, hey, I need to learn. I need to learn. I'll do all the legwork. I want to go find properties. I want to do this, but I don't have any money. I've got all the time. I don't have any money. I need to make something. But I need to learn this and learn and figure out what I'm doing. So that's one. I mean, if you've got time, no experience, and no money, you've got to go find a partner. Conventional loans is probably the easiest way. That's how I started. I had cash to get started, and then I got conventional loans. Basically, it started being called the Burr method in later years. What it was called in 2005 to 2008 was refi cash outs. It was even more beautiful pre-mortgage meltdown in 2008. Back then, I was able to, day one, I bought the house. I rehabbed it day 1 to 14. Day 13, I had my appraiser over at it, and I could bring my own appraiser who worked for me. And day 14, I had a check in hand from my mortgage broker. And by the way, I could have basically unlimited amounts of mortgages on my personal credit back then. And I did that up until the mortgage crash, basically July of 2008, which is why I couldn't ever get another mortgage for like years. I looked absolutely deplorable on my personal credit. It was awful. So friends and family, that would be a great place for you to start as well. If you've got anybody who, pooling money to start. Another great way would be wholesaling. Wholesaling is going to be a little tricky right now, just because nobody kind of knows which way is up. And people still really aren't going out. Some stuff is moving, but we're not even fully open yet. Nobody's really going out buying stuff. Some cities, some guys are rehabbing, some guys are working, but again, exterior remodels are going on, but you can't even remodel in certain neighborhoods. You can't without having code called on you. So that's a tough one, on even if you can wholesale effectively right now. And so friends and family, yes. IRA investors are a great source of underlying financing for wraparound money, because you can easily wrap. That's where I love to get wraparound money, because you can negotiate any terms you want, and you can say, okay, yeah, I'd love to do 30-year, and you can do a 5-year balloon if you want, or a 10-year balloon. A lot of times IRA investors will want 9%, or 8%. I've got 7% money, but again, I've been doing this 15 years full time. But so if you're interested, you can go to I go to Quest IRA meetings a lot. They do a lot of those Tuesdays if you're in Houston. Wednesdays are in Dallas. Of course, they're not going on right now. You're going to have to wait for those to start back up again. And then if we're talking about, and then private lenders are hard money. Issue with this, private lenders, yes. I mean, those are going to be any of your individuals, right? Just individual private lenders. Hard money is hard because a lot of those, the big guys, those guys are regulated, and they have these funds, these mortgage pool funds, and they are not allowed to have owner occupants in these houses. So if they find out that you're going to owner finance this and wrap this, that completely violates what they're doing. Now, off the record, do I work with some hard money lenders? And if they find out that, their owner finance professional is, I'm going to buy the note from them and we've set something up, yeah, okay, that's cool. It's not a big deal. But that's just a couple of the hard money lenders, and they'll call me up and go, hey, we got an issue, he can't sell the note, or he can't sell the house. Hey, can you basically underwrite this owner finance borrower and buy this note in 6 months from him, and then we'll approve this deal. And I'll go, okay, yeah, let's check this out. But I qualify it and I say, hey, if this borrower doesn't make his payments on time, I can't buy this thing, and so everybody knows what it is going through. But anyway, so those are sources of underlying financing. Again, cheapest and easiest money, of course, pre-COVID was, conventional loans. But friends and family, good place to start. If you've got somebody who's, got a line of credit, lines of credit are another good thing. You've got a way to do a HELOC on your house. So if you've got some equity in your house, or going to a small bank and going, yes, I'd like to get a business line of credit. On a caveat, I don't know how many people out there have applied for their economic disaster money. I don't know. Angel, have you?
We did, like at the end of March, and we still haven't seen anything.
Oh, you did at the end of March? Okay, so did you get your grant?
We did the is it the EIDL, EDIL?
EIDL, yeah.
We did that one, and we got a number, and we haven't heard or seen anything.
So I got in, whatever day it was, I was in 13 minutes after they opened.
Mm-hmm.
And I already got my grant.
Oh, wow.
Yeah, that came in, which means I'm approved, but I haven't gotten, and I've got my number, my application number, right? I got that night, right?
Yeah.
And I know I'm approved, but I haven't gotten one email. And then I sent an email and they told me that we've got a really high volume, so just be patient. And I was like, okay. So I know I'm approved because I got money just showed up in my bank account. And I was like, okay, cool. So, and I know I don't have to pay that back, which is great. That was for one of my companies, which is the Airbnb business, right? Which at that point, I could prove 6 figures in losses of revenue losses. I actually recovered all of those losses and am 100% occupied for the month of May. So I'm actually doing, again, I worked my ass off for a lot, right? Am I upset about those loans that I'm taking out? No. And I have plans for those loans, right? And what am I going to be using for those loans? Exactly what I'm talking about today. So yeah, no, do I know how much I'm approved for? I have no idea. But what do I intend on doing? This business plan right here is what I'm going to
I have
be
a
doing.
friend that he's really hoping he gets that $2 million because he 100% intends to turn it right back into real estate.
No, and they
just keep turning it.
They pretty much say that you're not allowed to buy real estate with it, but I'm kind of, I'm like, how do you actually know what I'm purchasing with it? But no, I'm absolutely planning on doing this business model with it. So yeah. And again, it's at 3.5%. And why wouldn't I do this? And you'll see exactly at like money sitting at 3.5%. Why wouldn't I do this? Because quite frankly, now I don't. All of that is paying off, and my note business is great. So yeah. So what note buyers look for? High interest rate, and by high interest rate, I mean 9 to 10%. And if you're sitting out there and wondering why 9 to 10%, and going, gosh, that sounds like highway robbery. It is not, okay? These people cannot go out and get a loan. And I don't want to hear the government's getting negative interest rates soon, or the banks are giving 2 to 3%. No, okay, no. You have to protect yourself. So know this, if you want to come to me one day and sell me that note, I am going to discount below 9%. Okay, so I will take money off of your sale below 9%. So you have got to protect yourself. So remember that. High interest rate, 9 to 10%. Low loan to value, that used to be 80 cents on the dollar, but remember, I'm expecting about a 20% discount. So right now, make sure that when you're setting these things up, go 75%. I'm hoping people understand what loan to value is. Loan to value is when you have your asset, that's your house, right? So you got your house, and your house is worth $100,000. But I don't buy houses. I buy pieces of paper. Okay? So the loan amount cannot exceed 75% of the value of that house. Loan to value of the house. I'm hoping I made that clear. Loan to the value of the house. So the value of the house is worth 100. Loan value cannot exceed 75%. So if that house is worth 100, the max value of that piece of paper, 75%. Okay? Good down payment, minimum 10% down, minimum. If you can get 20% down, run with it all day. I don't care what it looks like, run with it. And good property condition. Remember what we talked about. Don't be a jerk. I quote SpongeBob. SpongeBob is a really good guy. Don't be a jerk. Good roof, good HVAC, clean sanitary conditions. Okay? There's no reason to sell somebody that's something, sex. And then seasoning. I'm not going to buy something that's brand new, especially now today. I almost did. I almost got into that a couple of years back. I was going to buy stuff at the table. And then what I realized were that a couple of the investors, even though I thought they were good and honest, they started putting people in it with pulses. They just go out and find anybody and stick them in there. And so I really think that it encourages bad behavior to buy at the table. And so it's 6 to 12 months. So yeah, if seasoning needs to be 6 to 12 months, 6 months minimum, 12 months if you want my best price. Now, people always want to know, what are the prices for notes? Typically, I'm still paying it. I try to shoot for 90% of unpaid principal balance. That's about 15% higher than anybody else out there buying notes. And I suspect, especially with COVID hitting, that people are actually paying a hell of a lot less right now. I've seen prices go way down, and I'm like, no, I'm still paying what I'm paying. Everything, well, maybe about 5% less. A lot of the stuff I've seen lately hasn't been very good. Everything that I made offers on in the last month, I paid 85 to 90%. So I'm still pretty high, but anyways, so transaction example. Sales price is 100, just for easy math, so that I don't have to think very much. Down payment is 10,000, remember, because we have usually a minimum of 10%. Leaving finance 90,000, but remember, we have to have 75% max loan to value. So we have 75% at 10% interest for 30 years, giving our first lien a principal and interest. So that's what that PI stands for there, principal and interest. And that's kind of, your monthly cash flow is principal and interest of $658.18. And then we have a second lien at $15,000 at 10% interest for 15 years, $161.19. All right, so why do we break it into two? Because your first lien is basically covers your acquisition costs, your cost of rehab, okay? And so we sell that first lien, okay, and that pays for your acquisition and your rehab and gets rid of all your debt, right? Whatever it costs you to buy all of that, right? To buy all of that, and it gets rid of all your debt on that property. And your second lien is basically your profit, right? Your profit, and that's what you get for your kind of your cash flow. But don't forget, you also had your down payment, right? That's cash, and that's cash that you just get to keep. So that's kind of nice. So when you sell your note, right? And you got two pieces. So your sales price is based on note value, not on your ARV. So remember that. So you're going to sell your note at 90% of the unpaid principal value, based on a max loan to value of 75%. So there's a first and second lien. So you got 75,000 at 10% for 30 years, 15,000 at that. So you're going to sell your first lien for 67,500, and you're going to pay off all your underlying debt. Hoping everybody's following me on that. Okay? I don't know if we can see this. So you're going to sell your first lien, 67,000, pay off all that underlying debt, and then you're going to keep your second lien for $161.19 per month for cash flow. And you're also going to keep your $10,000 of cash. So you got $10,000. So you did this house, right? You bought this house. You bought it. We're going to say you spent $67,500. And that's was the cost of buying it and fixing it up. We're just putting it in a bubble. We're making it sound good. Okay? You bought it, you fixed it up, you sold it. You got $10,000 in cash. All the while you're making $161.19 per month plus, $658.18 over there too. You've now sold it, and you've sold your first lien. You now have no debt on this property, and you're still left with $10,000 in cash, and now you're making $161.19 per month in perpetuity for 15 years. Hoping if that's sinking in for everybody.
So how does the second lien part work?
What do you mean?
Well, I guess I'm stuck in conventional lending. So I'm thinking, well, how are you doing it? You can't have two. anymore.
Why? Why can't you have 2 liens?
Well, I
You
was
can have
like,
3 liens. You can have 4 liens if you wanted.
wow, because I know like when we bought our house in Lubbock, it was before.
Why can't you have 2 liens?
What? You can't at a bank, can you?
Yes, sure you can.
So you could finance the 20% that you have to put down?
Sure. Of course you can.
I thought
You
that
can
was-
go get a second lien on your house right now. It's called a HELOC. Go get a HELOC.
Okay.
Actually, Wells Fargo just put out yesterday that they stopped doing HELOCs. But technically, yes, you can go get a second lien on your house right now.
Huh. That kind of changes up my thoughts on things then, because I assumed that you just couldn't do it.
Sure. The only difference, I mean, first lien, second lien, senior lien, junior lien, legality. So the one legal caveat to this, you want to make sure that you write into your first lien that second lien holder has first right of refusal to cure default or to purchase first lien in case of default.
Yeah, I would have thought it would have been the other way around, but it makes sense. Yeah, Wanda's like, can you repeat that, please?
The legal part, Wanda. So you want to have written into the first lien that second lien holder has first right of refusal to cure default on first lien. So that means that, like, let's say that, so you're selling, right? So when you create this first and second lien, right? So you're creating this. And by the way, you're not doing jack, right? You're not doing jack shit. Your attorney is doing this for you. You're just giving your attorney direction on how to do this when you're setting this up. Okay? And by the way, send them this PowerPoint. They'll figure it out. All right? Send them this and go, okay, yeah, I want this, but with these numbers. You know, they'll know they're smart people. They'll figure out what you want done. Or just give them my phone number and they'll be like, okay, yeah, this will work. And just say, yeah, first right of refusal. So when you sell off that first lien, all of a sudden, oh my God, yeah, what if this borrower, and you've still got the same borrower, right? And all of a sudden they're paying you on the second, but they stop paying on that first for whatever reason. And likelihood is, if they stopped paying on the first, they're not paying on the second either. But stranger things have happened, right? Where all of a sudden they're like, oh, well, we'll keep paying on the second, but we stop paying on the first. Stranger things have happened, right? And that does happen sometimes. But, if that happens and you don't know about that, you still have the first right of refusal to go in and make that first current, right? And then you can foreclose on them and take control back of the property. And that's what you want, is just to keep control of that property if you have to. Again, put a good borrower in there. I have in my original 2008 batch, all of those borrowers, like I still have those borrowers. They haven't gone anywhere. So, don't think that, oh my gosh, they recycle every couple of years. No, they still live in those houses, and they don't move. And those people will probably own those houses the rest of their lives. So, and they might even pass those houses down to their kids. And I hope so. That'd be great. So again, yeah, just put into it first right of refusal. Does everybody get this? Because now I got the gold. Like, everything's going off for the next slide. You ready? I hope this is good. All right. So building your own finance business. So start conservative. Goal of 8 transactions. And this is 2020. I know we're kind of halfway through, and I know we got COVID going on. So this might be a little aggressive. And I put 2020 because when I first did this one, it was for a January presentation. So, whatever. So 8 houses with ARVs of $100,000. We're talking about $800,000 total. At the end of the year, you've made $80,000 in cash, and you've created an income of $1,289.52 per month. Okay, that's $161.19. Because let's be honest, $161. I mean, come on, that's going to cover my Starbucks for the month, right? But then when you're talking about $1289.52 per month, okay, well, now we're talking about some money, you know. And so in 2020, with only 8 houses, you'll make $80,000 in cash. And I don't know how many people are watching right now who have a salary of $80,000 a year. It may be a lot, it may not be a lot. But I have a feeling that, you know, that kind of money starts to sound pretty good, because at $1289.52, your reoccurring salary is $15,474. Then when you actually start doing some really good math, because you do that 4 years in a row, after 4 years, you are, you know, you're making $62,000 a year for doing nothing. 62. And that's your salary, is $62,000 a year. And by the way, that's all on seconds. That's not even first. And then if you start actually using some of that cash that you've been building up, right? Because, you know, that's $62,000, but, you know, 4 years, you know, and that's just doing 8 houses. I mean, obviously, you know, if you've got $62,000 a year, you know, I'm hoping you kind of left your day job, your 9-to-5 day job, if you're making $62,000 a year, because I have a feeling that might be a higher salary, since, what is it? The average 2-income family makes $24,000 a year, right? I think it's 24,000, 42,000, something like that. So $62,000 a year sounds pretty damn good to a lot of people. You know, 80,000 times 4, that's 320, plus $62,000 per year. Yeah, you start talking about a lot of money. And each of those years adds up. You can start to actually hold on to some of the first liens as well. And all of that snowballs, you know, and so now you're not having to sell off, you know, even your first liens. And when you're talking about your first liens, those are $658 per month. So you can really, really increase your monthly salary. So what I love to tell people is, yeah, you know, for me, yes, am I going to be increasing my portfolio this year? Yes, I am. But I have more money than time. So I buy notes, is what I like to do. You know, when you have more time than money, yes, this is the way to get started, and this is what to do, and this is the way to learn this business, and, you know, be in the trenches. And it's fun too, you know, you get to rehab some, and, you know, and do all that, and it's fantastic. But what I love to tell people is, yeah, when I pick up a note and, you know, it's $1,000 a month, I just gave myself $12,000 a year raise. And when you start realizing that, yeah, you know, a $12,000 a year raise, gosh, wouldn't you love to give yourself a $12,000 a year raise every month? I know I do.
Yeah, these numbers are awesome.
Yeah, these numbers are, yeah, this is life-changing when you actually look at them. I mean, yeah, you know, I put $161 a month, and people are like, whatever, you know. But when you actually start and go and make a plan and go, okay, yeah, you know, I can add this up, and I can go, all right, well, you know what, $1,200 a month, really, that actually does start to change my life. $1,500 a month, $1,600 a month. Because, I mean, you know, what's your car payment? What's your rent? You know, how much do you need to actually survive every month? What do you need to actually not have to go anywhere? You know, and there's enough people right now that, you know, this right here is the difference between making it through the end of the year, going, gosh, I wish I'd watched this program a year ago. Do you have more questions?
I'm not seeing any. I'm just.
No, do you personally have more questions? I can see you're digesting.
Well, I'm just blown away. I mean,
I know you got quiet all of a sudden. I'm like, you're never this quiet.
It just kind of changes things, because it's another way to be passive
Oh,
but
this is all
you're making
passive.
so
And
much more.
this is the beautiful thing about notes. And people are like, but this is originating notes. And people are always like, oh, well, I'm not a note investor. I'm an owner finance. I'm like, you're a note investor. And you don't realize that owner financing is notes, but it is. This is all note investing. You're just creating money out of nothing.
Well, it flips it, because like we personally have looked to purchase owner financing like units because we don't want to have to go to the bank. We want to be able to purchase outside of the bank. But this is flipping it to the other side, where now we'd be the bank.
You would be the bank, which
And it's just a
I
different
tell
way to look at
people,
it.
be the bank. Always be the bank. And when you start, so you sell $100,000 house, right? And I'm just looking at my phone. So, and I'm gonna show, hold on, I'll show people what I'm doing first. So here's my little finance. I don't know if I can get this up close enough. Okay, there it is. There's my little pink pig. Okay, so I love this little pink pig app, and it's kind of coming. Sorry. So you sell $100,000 house. Remember our made up numbers? We're into it for like 67.5, which is pretty much ridiculous, right? In a pipe dream right now, but whatever it is. So 67.5 at 30 years over 10% interest. This thing, your total amount that you're actually going to make is $284,000. Yeah.
Wow.
You make so much more money owner financing than you do when you and granted, you've got debt underneath that. So, once you're actually using 100% of your own money, yeah, you're making so much more money doing this. People are always like, well, why are the banks able to pay back, back in 2008, how are they able to pay back all of that bailout money in less than a year? Because they know how money works and they understand how to make money.
Well, because they're making that kind of money on so many more transactions.
Yes.
And they don't want to foreclose because they're not in the real estate business.
They are not.
They're in the money-making business.
Yes. They are in the business of lending money. They are not in the business of owning property. And so if you can get that in your, God bless new real estate investors, bless them. I hear all the time, oh, I want to own all of DFW, or I want to own all of Texas. And I just smile, right? And I smile and I'm polite, but inside I'm laughing my ass off. And and I don't say anything, because I was them once. I remember actually thinking that at one time. I'm like, hell no, I don't want to own all of DFW. Are you kidding me? Owning a piece of property is called a liability. It is. You own a piece of property, you are liable for everything that goes on at that location. I don't want to do that. No way. I want to own a piece of paper. Piece of paper means I get to make money. Plain and simple. So remember that, and I have this argument with people all the time. And they're brand new. They've been doing this a millisecond. And they're like, oh, what about depreciation? Great. Your taxes look great for like 2 years. Cool. Enjoy them. I can tell you right now, I'm making a shit ton more money for less 10 years. Tell me how that goes for you.